Oil price volatility is continuing this week, even after the carnage of last week, which came as the May WTI expiry ended, and we saw incredible levels of volatility at the start of the week. WTI, the May price dropping to minus $40 a barrel at one point. In effect, people paying others $40 per barrel to take oil off of their hands. Now, the question was always going to be whether that volatility would follow through into the June contract and affect effectively all oil futures in the near future and affect oil prices really around the world. And we have seen that over the course of the last week or so. Now, we haven't plunged into negative territory as of yet, but we are seeing oil prices come under severe pressure. And now there are reports emerging of various oil funds actually selling the June futures as well, already well ahead of expiry, in order to avoid the kind of scenario which emerged early on last week. Now, that actually caused a lot of volatility in oil prices earlier this week. What we saw was the USO, which is the largest oil ETF in the US, actually announcing that it was going to be selling all of its June contracts for WTI and spreading it out along the rest of the futures curve. Now, this represented around 20% of its portfolio, which in effect is $3.6 billion. So this was a huge position which they were looking to shift over the next few days. So that only didn't just put pressure on the curve in the near term because there was going to be a lot of selling activity, but obviously if you're owning one of those futures contracts, then that seems to have encouraged investors to flee ahead of the move and also put downward pressure on prices as a result of that as well. And that really brought down oil prices across the board, even Brent crude coming under pressure earlier on this week. Now, we have seen that bounce back a little, but any hope that we are going to see volatility dissipate over the next few weeks is really unlikely. And there's two reasons for that, really. One is the fact that just because we're seeing maybe a little less activity than we otherwise would in that June contract, that doesn't mean we're going to have less volatility. In fact, illiquid markets can often be the most volatile. So the closer we get to that expiry date, I would expect to see oil prices continuing to experience extreme levels of volatility. Also, around the same time of that expiry in mid-May, we're expecting US storage to reach capacity. So unless we see other storage facilities emerge or production come off quite dramatically, and we haven't really seen that in the US yet, the last couple of weeks only showing 100,000 barrels being reduced in the US each week. Unless we see one of those two things happen, then the next 2 weeks could be extremely nervy and therefore extremely volatile for oil prices. In terms of what that means for the Oanda WTI price, we have seen it kind of low around the $12 mark and kind of steady around those levels. We have seen a little bit of a bounce over the course of the last 24 hours or so, but I still think this is a price which is considerably under pressure and which could come under further pressure over the course of the next few weeks as volatility does re-emerge and as we do near that expiry and those capacities over in the US. So we are seeing those kind of any bounces really being sold into. We're seeing the lower highs emerging as well. So while $12 has represented a floor for now, if that breaks, then we could see that being the catalyst for further declines. I think the key thing to see here is that volatility is going nowhere in the oil markets in the immediate term. And as a result, we could continue to see these very wild swings until we start to see some form of balance emerging in the markets, which reduces those capacity concerns.